Ryan and Ethan graduated from college in the same year, same age, same city, same salary, 24 years old, both living in Chicago. Both obsessed with the idea of becoming financially free before 40, and at first, their lives looked almost identical. Small apartments, student loans, credit card debt, cheap furniture from IKEA, shared Netflix passwords, late-night Uber Eats orders they both knew they couldn't afford. But somewhere beneath that normal life, a financial split was quietly beginning. Not because one was smarter, but because one was becoming emotional. While the other was becoming systematic, Ryan loved the market, not investing the market. There's a difference. Every morning, before even brushing his teeth, he checked stock prices, Tesla, Apple, Nvidia, crypto charts, AI startups. He followed finance creators on TikTok, watched YouTubers screaming about the next 100x stock, listened to podcasts from millionaire traders living in Miami penthouses, and slowly, investing stopped being financial. It became emotional entertainment, because the modern stock market no longer feels like mathematics. It feels like social media. Fast, emotional, addictive. And Ryan loved that feeling. The adrenaline, the possibility, the fantasy that one perfect trade could completely change his life. Ethan was different. Not boring, not unambitious, just quieter. While Ryan chased predictions, Ethan became obsessed with systems. One night, while both of them were eating cheap tacos after work, Ryan started talking about a stock he believed would explode. This thing could triple in 6 months. Ethan looked at him for a second, then asked something simple. What if it doesn't? Ryan laughed immediately. That's why you diversify. But Ethan kept staring at him. No, what if your entire mindset is built around chasing excitement? That sentence stayed in Ryan's head longer than he expected, but not long enough to change him, because social media was louder, and the internet rewards excitement, not patience, especially in America. A country built on speed, fast money, fast success, fast growth. Everything around them reinforced the same message: get rich faster. Ryan started investing aggressively. His salary was $70,000 a year, but emotionally, he already imagined himself becoming a millionaire. He bought volatile tech stocks, risky growth companies, crypto projects he barely understood. Sometimes he made money, and those moments felt incredible. A stock jumped 40%, a crypto coin doubled overnight, and suddenly, Ryan felt smarter than everyone else. That is the dangerous part of early investing success. It changes identity. You stop feeling lucky, you start feeling gifted. And once ego enters investing, discipline quietly disappears. Ethan saw this happening in real time, but he said nothing, because Ethan wasn't trying to win emotionally. He was trying to survive financially, every month automatically. Without thinking, Ethan invested into index funds, S&P 500, total market funds, retirement accounts. Simple, quiet, systematic. No screenshots, no excitement, no viral tweets. And honestly, Ryan thought Ethan was wasting time. You'll never get rich investing like that. That's what Ryan told him one winter night while scrolling through stock charts at 2 a.m. Ethan smiled, then said something Ryan didn't fully understand yet. I'm not trying to get rich fast. I'm trying to avoid staying broke emotionally. At 26, the differences started becoming visible. Ryan upgraded his lifestyle first: luxury apartment, BMW lease, expensive watches, high-end gym membership. Not because he was truly wealthy, but because his portfolio gains made him feel wealthy. This is what modern investing culture does psychologically. Temporary profits become identity inflation. People start spending based on unrealized success, especially online, because social media quietly trains people to perform success before they actually own it. And Ryan was becoming part of that system. Every market win increased his confidence. Every expensive purchase reinforced his image. Meanwhile, Ethan still lived below his means, still invested automatically, still ignored financial influencers, still drove the same old Honda. And from the outside, Ryan looked far more successful. That's the illusion. Excitement always looks richer in the short term. Then the market changed. Suddenly, violently, interest rates increased, tech stocks collapsed, crypto crashed, layoffs started spreading across America. And overnight, Ryan's entire emotional system broke apart. Because aggressive investing feels amazing during bull markets, but psychologically devastating during crashes. Ryan stopped sleeping properly, checked his portfolio constantly, watched thousands disappear every week, and the worst part, his lifestyle was now too expensive to maintain comfortably because his spending had expanded during temporary success. This is how financial pressure traps people. Income rises, confidence rises, lifestyle rises, then markets fall, but expenses stay. And suddenly, the emotional pressure becomes unbearable. Ryan started panic selling, then rebuying, then panic selling again, because emotional investing creates emotional decision-making. Meanwhile, Ethan kept investing. The market crash didn't excite him, but it didn't destroy him either, because he never built his identity around market performance. That changes everything psychologically. When your self-worth is connected to investments, every market drop feels personal. But when investing becomes systematic, market crashes feel temporary, not emotional. By age 32, their lives looked completely different. Ryan still chased opportunities constantly, still searched for the next big thing, still consumed endless financial content online. But emotionally, he was exhausted, because trying to outperform the market forever becomes mentally draining. The constant predictions, the uncertainty, the pressure, the comparison, and social media made it worse. Every day, someone younger seemed richer, someone else seemed smarter. Another creator claimed they made millions from one stock, and slowly, Ryan realized something painful. The internet monetizes financial excitement, even when audiences lose money following it. That realization changed him. Meanwhile, Ethan quietly kept building wealth, not dramatically, systematically. His index funds compounded slowly over years. His retirement accounts expanded. His taxes became more efficient. His stress remained lower. His cash flow improved, and eventually he bought a home. Not to impress people, not for content, not for social media validation, for stability. That difference matters, because stable financial decisions create stable emotional lives. Ryan noticed this one evening when he visited Ethan's house. Nothing looked extreme, no supercars, no luxury flexing, no fake millionaire energy, but something felt different. Peace, real peace. And Ryan suddenly understood something terrifying. For almost 10 years, he had been chasing financial intensity instead of financial freedom. That realization hit harder than any market crash, because the truth about investing is uncomfortable. Most people are not losing money because they lack intelligence. They lose because modern financial culture manipulates emotion. The market became entertainment, and entertainment rewards stimulation. But wealth usually rewards consistency. That's why index funds became powerful, not because they are magical, not because they guarantee success, but because they reduce psychological self-destruction. They remove constant emotional decision-making. They simplify behavior. And simple systems survive longer than emotional strategies, especially in modern America, where financial pressure already exists everywhere. Rent, insurance, mortgages, healthcare, debt, subscriptions, taxes, lifestyle expectations, social media comparison. People are mentally exhausted already. Adding emotional investing chaos on top of that breaks financial discipline even faster. By 35, Ryan finally changed, not completely. He still invested in some individual stocks occasionally. But now, most of his money went into index funds. And ironically, the moment he stopped trying to beat everyone else, his financial life became more stable. Less exciting, but more powerful. Because real wealth rarely feels dramatic while it's being built. That's the biggest lie social media never tells people. The strongest financial lives often look boring from the outside. Quiet investing, controlled spending, long-term thinking, emotional discipline. No constant flexing, no desperate chasing, just systems. And maybe that is why smart people choose index funds over stocks. Not because they lack ambition, but because eventually they understand something deeper than the market itself. That freedom is not built by constantly chasing excitement. It is built by surviving long enough for consistency to compound. And in the modern attention economy, where everybody is emotionally reacting to everything, that mindset quietly becomes a financial superpower.